In an era where everyone thinks their opinions are so damn important, I'm here to give you a little piece of my mind. Welcome to Unaffiliated the Podcast with your host, B. Seth. Let's go.
Everybody knows when you're in here, you're dropping some kind of financial nuggets. So let's dive right into it. For all the listeners, we are not financial advisors. Anything you implement with given information has a risk attached to it, so do it at your own discretion. With that being said, what are we diving into tonight, brother?
Tonight, let's just talk about, I guess, a well-rounded overview and understanding of finances and how to hold and how those things should be held. A lot of times, I know people hear all the trends. Get into real estate or get into stock investing, get into now the crypto and the NFT markets and all these things. But all these things, they carry a risk. So a lot of times when I'm, giving people instruction or giving guidance on so far anything that's financially related, we like to call it the rule of 1/3. So a rule of 1/3 is you keep 1/3 liquid, which liquid in these terms, we're talking about cash. Cash that's easily accessible, easily transferable, easily spendable, doesn't require much for you to get access to it. That could be a bank account, checking account, or whatever the case may be, savings account. Anything liquid or even a market fund. Sometimes your investment account will give you a market fund, which basically acts as cash. The other rule of the 1/3 is we keep a 1/3 in a tangible asset. When we talk about tangible asset, I'm talking about real estate. That's probably the most prevalent tangible asset that most people will have access to invest in. And so we keep a third in tangible asset, which is real estate. With the real estate, the cash may not be as accessible, but that tangible asset should be increasing in value. You should have means and ways to be able to pull cash out of it if you need it, so far as any equity increases in the property, and or just leveraging the property to get loans out against it and things of that nature, which, it still has a cash component to it. It's just not as liquid as the first 1/3, which should be your quick, easily accessible cash. The last 1/3 we like to call non-tangible assets. So the difference is tangible asset is an asset you can actually hold, feel, touch, put your hands on. That's real estate. A non-tangible asset would be the stocks, the bonds, the NFTs, the cryptos, the things that we know exist, but we just can't really put our hands on it, and really not such a tangible component to it. It's more of a theoretical component. So that's what we call a non-tangible asset. Now, just like the tangible asset, the non-tangibles, they may or may not increase in value. You may or may not be able to pull cash out of that asset. You may or may not be able to loan against that asset, but it does have a cash component to it, but it's just not quickly accessible or quickly to be able to get your hands on. So anytime I speak with people, you want to keep your money in these type of buckets, or your wealth. 1/3 cash, 1/3 tangible asset, which in this case we're talking about real estate. 1/3 non-tangible assets, which the list can go on and on now that you have the crypto, the NFTs, the stocks, the bonds, any type of, CD, any type of market investment fund that you may have had your mind on.
Okay, cool. So earlier you were talking to me about the 7-year rule. Is that what that is?
Right. So in any time we're talking about money, and that's why we keep the money in these different pockets. So anytime you have money or any type of asset that has value, in finance we actually call it Rule 72. So Rule 72 is you take the interest rate or the rate of return you're receiving, whether it's 10%, 8%, whatever it may be, and you divide it back into that 72. Mm-hmm. So if we're getting 10% interest, we divide it into that 72. That means in 7.2 years, whatever that initial investment is, it should have doubled in 7.2 years. So the simplest calculation, the simplest breakdown of that rule is you base it on a modest return, which is 10% with the 72, and your asset should be doubling every 7.2 years. So meaning if we started off in year one with $100,000 and we're getting a 10% return in 7.2 years, that 100,000 should be 200,000. And whether that's cash, tangible or intangible, the value of that asset should be doubling every 7.2 years. I think the number one thing is people have a tendency to want to keep a lot of cash, and I think that's why
cash not king.
Cash is not king.
Okay.
Now, cash does speak volumes in certain scenarios where you're able to, put a lot of money down, or you're able to cut through some things because, hey, I'll give you $100K today if we can do this deal
right now.
But a lot of times your cash has a diminishing component to it because it does not keep up with inflation.
Okay.
So what that means is, let's talk about Dollar General or Dollar Tree, whatever the name is. Dollar Tree is now going to $1.25.
Right.
The reason for that is that dollar is no longer worth $1. So what we were exchanging with Dollar Tree for $1, now that dollar is no longer worth $1. So they're having to increase their base costs in order to get back to that dollar. So now they're asking you for $1.25, which now $1.25 has the same buying power as $1 had last year.
Right.
So what that means is that keeping too much money in cash, you're losing that quarter that we're just having to give up now. And Dollar Tree is a small example. So if you take $100,000 and if you extrapolate that example out, that $100,000 now has less buying power than it did last year. So now that $100,000 may have equivalent buying power of $92,000 last year.
Right.
As opposed to that. So the biggest mistake a lot of people make is, I'm going to just keep my money in cash because I can keep my hands on it in X and Y and Z. But when you're doing that, the money is not working for you. The difference is with the tangible assets and non-tangible assets, you're putting that money to work.
Yeah.
So that money is, in essence, trying to outpace inflation. And as long as that money is keeping up with and or outpacing inflation, then that money is working and it's increasing in value. And so that's where you get the 7.2 rule, the 7.2 years where that money is doubling.
Okay.
In cash, it doesn't have the opportunity to double because it's in essence always sliding behind inflation.
Okay. Yeah, that makes a lot of sense. So you're one of the few people I know who have gold bricks and silver bricks. What are some of your preferred ways to diversify your money?
Yeah, so when I was, starting out and trying to figure out my path, I went down many roads. We had the cash road that we just spoke about. I used to keep large sums of cash. I keep a safe and all that stuff.
Yeah.
Large sum of cash. I went through diamond investing. Diamonds were a gold mine at one point.
How was that?
Meaning that people would put their money into diamonds, hoping to catch the increased value of the diamond and then being able to cash out. And so I was investing in yellow diamonds, pink diamonds, and things of that nature. But what happened was the yellow diamond almost became the new standard and became the new white. So when that happened, that yellow diamond's rarity went down, and now you're actually losing money because now they're not worth as much as what they should have been. So I've done, and that's another form of a tangible asset. It's something we can put our hands on. I've also invested in, as you mentioned, into the metals, which would be the gold, the silver bricks, and things of that nature. The problem is when you're investing in any of these type of minerals and metals, they're not as easily liquidatable. Yeah. Meaning, especially determining on the type of volume that you're controlling. You have to go to a special market to be able to get rid of so many carats of diamonds, or you have to go to a special market to be able to get rid of so many ounces or pounds of gold or silver. So those are harder to get rid of because of the issue with liquidating. Other things that I've done, as I've been on this path, of course we've beat it over the head a million times, is real estate. The thing with real estate, it's a slow game. Real estate is about, you buy one, you sit on it, you move to the second, to the third, to the fourth, and hopefully over time you're able to compound those purchases, and now you're able to leverage the previous purchases. And when we spoke about the 7.2 year rule, those first couple of purchases now should be doubling, and you should be able to now leverage those to be able to buy more. But now you're looking at a 7.5 year that's passed, and a lot of times in today's society we want to get there quickly. So when we're talking about getting there quickly, let's go to the non-tangibles, which are going to be the stocks, the bonds, which are going to be now the crypto world, the NFTs. And this is where people now are putting everything, which, there's not a problem with that. But the issue is that we have to be ready for whatever falls may happen in the market. Just like we see the quick rises, if it goes up fast, it comes down even faster.
Right.
Be sure to follow Unaffiliated the podcast on Apple Podcasts, Spotify, and now on YouTube.